Slide 1, Advanced Audit Techniques, Deconstructing the Purchasing Cycle. Welcome to our deep dive into the purchasing cycle, the financial battlefield where seemingly mundane transactions conceal the most sophisticated misstatements. Listen up, people. This isn't textbook theory. It's a masterclass in navigating the most complex audit terrain you'll encounter in your career. The purchasing cycle isn't just another transaction stream. It's where financial fraud goes to hide in plain sight. Imagine the purchasing cycle like an iceberg. What you see above water is just routine transactions, but lurking beneath is where the real danger lies. To learn accounting, you must do accounting. And nowhere is this more true than in the purchasing cycle. Think about this. Every major accounting scandal in history has roots in the purchasing process. WorldCom ? Capitalized expenses that should have been expensed. Enron. Manipulated purchasing arrangements with special purpose entities. I'm telling you right now, mastering this cycle is like having X-ray vision in a world where everyone else is walking around blind. The purchasing cycle is to financial statements what the foundation is to a skyscraper. Invisible to most observers, but absolutely critical to integrity. You can have the most beautiful revenue recognition in the world, but if your purchasing cycle has termites, the whole structure will eventually collapse. Remember, folks, in auditing, you're either the hammer or the nail. Today, I'm teaching you to be the hammer. Slide 2. Overview of topics. Our technical dissection covers 3 critical dimensions of purchasing cycle assurance. First, we'll deconstruct expense and liability recognition principles through the lens of accounting codification. This is like learning the DNA sequence of financial reporting. The principles in ASC 330, 450, and 840 aren't just accounting rules. They're the genetic code that determines whether financial statements live or die. Imagine you're reviewing December transactions at a Fortune 500 retailer. Everything looks perfect on paper, but something smells fishy. That smell? It's the gap between technical compliance and economic reality. Just like a chef knows when a dish needs salt without measuring, a great auditor senses manipulation even when it technically follows GAAP. Second, we'll analyze process architecture vulnerabilities. Think of this as learning to spot the weak points in a castle wall before the invaders do. Picture yourself as a financial detective walking through transaction flows, noticing how receiving data transfers between systems with a 3-day lag. That's not just a timing difference, that's a manipulation opportunity begging to be exploited. Finally, we'll examine precision targeting in testing approaches. Standard audit programs are like fishing with a net. You might catch something. The techniques I'm showing you are like fishing with a spear, targeted, precise, and deadly effective. Remember, people, to learn accounting, you must do accounting. And to master audit excellence, you must think like a financial fraudster before they do. Slide 3. Defining expenses and liabilities. The technical foundation begins with precise recognition criteria. Listen closely. Expenses and liabilities aren't just accounting concepts. They're economic battlegrounds where financial wars are won and lost. Expenses are like oxygen molecules leaving your body. Once they're gone, your financial health diminishes. But here's where it gets tricky. When should that recognition happen? Imagine the matching principle as a dance between revenue and expense. In perfect accounting, they move in perfect synchronization. But in the real world, management is constantly trying to make expenses sit out a few beats while revenue dances alone. ASC 605-10-25 isn't just technical guidance, it's the choreography manual for this critical dance. Liabilities represent probable future sacrifices, but probable is like the word love. Everyone has their own definition. ASC 450 says probable means likely to occur, but I'm telling you right now, I've seen likely mean 51% at aggressive companies and 99% at conservative ones. Imagine you're examining a client's warranty liability, where the definition of probable magically shifts from 85% to 95% just when management needs to reduce expenses. Coincidence? About as coincidental as finding your teenager at home studying on prom night? The recognition criteria are to accounting what the Ten Commandments are to religion. They dictate all that follows. To learn accounting, you must do accounting. And to truly understand recognition principles, you must see them manipulated by masters before you can protect against the abuse. Slide 4. Categories of expenses. The technical classification of expenses creates 3 distinct audit territories, each with its own risk profile. Product costs are like financial sleeper agents. They infiltrate the balance sheet as inventory before attacking the income statement later as COGS. Imagine Netflix's content costs. Billions in programming sitting quietly as assets, waiting for their moment to strike the income statement through complex viewership algorithms. It's like watching a spy movie where the enemy agents are hiding in plain sight. Your job isn't just to count them, but to verify they belong in the country at all. One mistakenly capitalized period cost can be more dangerous than 100 properly handled inventory items. Period costs are the kamikaze pilots of the expense world. They hit the income statement immediately with full impact. Picture Amazon's fulfillment expenses, massive outflows that slam earnings the moment they occur. The temptation to capitalize these. It's like putting a hungry dieter in a room full of chocolate cake and asking them not to take a bite. Systematic allocations like depreciation are the marathon runners of expenses, steady, predictable, and in it for the long haul. But here's where management gets creative. Changing useful lives midstream is like moving the finish line in a race that's already started. It's technically allowed, but it sure smells fishy. Each expense category creates different hiding spots for manipulation. Product costs can be inflated through phantom inventory. Period costs get improperly capitalized. And depreciation? Those estimates can be stretched like spandex at a buffet. Remember, folks, to learn accounting, you must do accounting. Your textbook showed you the what. I'm showing you the how and why of expense manipulation. Slide 5. Purchasing process flow. The purchasing cycle architecture consists of 4 sequential control environments. Picture this like the security checkpoints at Fort Knox, each designed to stop financial theft, but each with potential blind spots. The requisitioning function is your first line of defense, like Border Patrol checking who gets in. Imagine Tesla during Model 3 production hell. Normal requisitioning controls were bypassed faster than speed limits on a German highway. The purchase order phase is like engagement before marriage, a commitment without the final paperwork. But here's the trick. In accounting, the engagement period can be stretched or compressed to achieve specific reporting outcomes. It's like proposing to someone but keeping the date flexible based on your bank account status. Receiving is where the rubber meets the road. Physical possession meets financial recognition. This is the accounting equivalent of the wedding ceremony. But just like some people have secret weddings, companies sometimes forget to record the event until a more convenient time. Picture a distribution center receiving holiday merchandise in December, but holding the receiving reports until January. That's not a timing difference. That's a deliberate accounting manipulation. Payment execution is the final chapter, like the honeymoon after the wedding. But even here, timing games can be played. The payment system is to purchasing what brakes are to a car, the last chance to stop before impact. Each phase doesn't just process transactions. It creates evidence that either supports or contradicts the financial story management is telling. Remember, people, to learn accounting, you must do accounting. The purchasing flow isn't just an academic concept. It's a living battlefield where financial accuracy lives or dies every single day. Slide 6. Types of purchase transactions. Transaction classification creates three distinct testing territories. Regular acquisitions are like the everyday traffic on financial highways, high volume but following predictable patterns. Imagine Boeing's complex supplier arrangements, where liability recognition is as complicated as a quadratic equation. These aren't simple buy now, pay later transactions. They're multidimensional arrangements where the buy and pay have more conditions than a celebrity prenup. Think of regular purchases like the main course of a meal. They represent the bulk of what you'll consume. But just like a chef can hide questionable ingredients in a complex sauce, management can conceal manipulation within the volume of routine transactions. Disbursement transactions are like the delivery system of the financial body, moving resources where they need to go. Picture your payment controls as blood vessels. They need to be strong enough to handle pressure, but flexible enough to adapt to changing conditions. JP Morgan Chase processes billions in payments daily with a control system more complex than NASA's mission control. Yet even they experience fraud because one authentication system had a vulnerability. Return transactions. They're the salmon swimming upstream in your transaction river. They move against the normal flow, making them inherently harder to control. Imagine returns as driving backward on a highway. Possible, but requiring much more attention and control. At companies like Zappos with liberal return policies, the return process isn't just a transaction type, it's a complete control subsystem requiring specialized monitoring. Each transaction category creates unique risk profiles demanding specialized procedures. Remember, to learn accounting, you must do accounting. Understanding transaction types isn't just classification, it's learning to spot where the financial bodies are likely to be buried. Slide 7, Essential Documents and Records. The documentation architecture creates an interlocking evidence framework. Think of documents as the DNA evidence in a criminal investigation, each strand telling part of a larger story. Requisitioning and purchase documentation establish intent, like text messages before a crime. They don't prove completion, but they show what was planned. Imagine Amazon's purchasing documentation, where algorithms generate orders without human intervention. It's like having a robot witness who can't be cross-examined. When the system itself is the purchaser, traditional authorization concepts get turned on their head like a financial gymnastics routine. Receipt and invoice documentation are the eyewitnesses to the transaction crime scene. They testify that something actually happened. Picture FTX's catastrophic failure where billions in transactions lacked basic documentation. It wasn't just missing paperwork, it was the accounting equivalent of a murder with no body, no weapon, and no witnesses. Disbursement records provide the final verification, like the murder weapon with fingerprints intact. They don't just prove payment, they create an evidence trail that's nearly impossible to erase completely. Documentation isn't just paper or digital records, it's the skeletal system of financial reporting that determines whether the body can stand upright. Think of documentation as financial storytelling. Each document adds a chapter, and together they create either a consistent narrative or a contradictory mess. Remember, folks, to learn accounting, you must do accounting. And understanding documentation isn't just knowing what forms exist. It's learning to read between the lines to find what the forms aren't telling you. Slide 8, Major Functions of Purchasing. Functional segregation creates specific control environments. Imagine purchasing functions as specialized organs in the financial body, each with a distinct purpose but all working together. Requisitioning establishes legitimate need, like the brain deciding what the body requires. When this function fails, the entire organism makes poor decisions. Picture Amazon's purchasing architecture where warehouse systems generate automated requisitions. It's like having a nervous system that operates without conscious thought. The technical challenge isn't just verification, but understanding algorithmic decision-making that operates at superhuman speed. Receiving and invoicing functions create execution verification. like the eyes confirming what the brain requested actually arrived. Target's receiving function with EDI integration creates automated matching through system rules. It's like having a security camera that not only records but also analyzes the footage without human intervention. Disbursement functions complete the cycle through resource deployment, like the hands delivering what the brain decided and the eyes verified. Each functional area creates specific control domains requiring specialized evaluation. The functional framework isn't just organizational design, it's the central nervous system of financial integrity. Segregation of functions is to internal control what separation of powers is to government, a fundamental protection against concentration of authority. Remember, people, to learn accounting, you must do accounting. And truly understanding functional segregation means seeing not just how functions are separated, but how they're integrated to create a complete control framework. Slide 9. Segregation of duties. Introduction. Segregation principles establish the structural foundation of control architecture. Think of segregation like the security protocol for nuclear weapon launches, requiring multiple people with different keys to authorize a single action. It's not bureaucracy, it's essential protection against both fraud and error. Imagine Wells Fargo's account opening scandal, where sales targets aligned with verification authority. It's like asking the fox to guard the henhouse while promising him chicken dinners for good performance. Segregation isn't just preventing fraud, it's making fraud so difficult that it requires collusion, which exponentially increases the risk for perpetrators. Picture segregation as a system of financial checks and balances. When all power concentrates in one position, abuse becomes not just possible, but probable. It's like having the same person write, approve, and cash checks to themselves. Not just a vulnerability, but an invitation to fraud. Segregation isn't about trust, it's about structure. The most trusted employees can still make mistakes, and even honest people face temptation when opportunity and pressure align like planets in a rare astronomical event. Remember, folks, to learn accounting, you must do accounting. And understanding segregation isn't academic. It's recognizing the human psychology that makes it necessary in the first place. Slide 10. Segregation of duties. Details. The technical implementation of segregation requires 4 distinct control domains. Authorization functions are like the gatekeepers of financial activity. They determine what transactions are permitted to enter the system. Imagine Walmart's authorization architecture with multi-tier thresholds. It's like having different security clearances for different levels of classified information. Authorization is to purchasing what judges are to the legal system. They determine what proceeds and what gets rejected based on established criteria. Without proper authorization, the purchasing system becomes as chaotic as a courtroom without a judge. Custody functions control physical and electronic asset management, like the guards at Fort Knox who can see the gold but can't authorize its movement. Picture custody as handling nuclear material, strict protocols, limited access, and constant monitoring to prevent both theft and contamination. Record-keeping functions document activity without execution authority, like court reporters who record proceedings but can't influence outcomes. Imagine letting someone both execute transactions and record them. It's like allowing students to both take exams and grade them. The temptation would be overwhelming. Reconciliation functions provide independent verification, like election observers, ensuring votes are counted accurately regardless of outcome. The segregation framework isn't just organizational design. It's a sophisticated psychological defense system against human weakness. Remember, people, to learn accounting, you must do accounting. And effective segregation isn't just separating duties. It's creating a system where fraud requires multiple people to collude, exponentially increasing both difficulty and risk. Slide 11, Inherent Risk Assessment, Part 1. Industry-specific risk factors create unique vulnerability vectors. Supply disruption introduces procurement pressure that challenges normal controls, like a drowning person who will grab anything to stay afloat, even if it's not a proper lifesaver. Imagine semiconductor manufacturers during chip shortages, where normal processes were bypassed, like speed limits during an evacuation. Market volatility creates valuation complexity that challenges consistent measurement, like trying to measure a moving target from a moving platform during an earthquake. Picture energy companies during price spikes where standard costing models fail, like weather forecasts during a hurricane. Competitive pressure introduces margin challenges that incentivize manipulation, like weight limits before a championship boxing match that tempt fighters to use dangerous dehydration techniques. These conditions don't just affect business operations, they create specific financial reporting risks that standard audit programs often miss. Think of industry factors as the weather conditions of your audit environment. They don't determine what you do, but they absolutely influence how you do it. Remember, folks, to learn accounting, you must do accounting. And understanding industry risk isn't just background knowledge, it's recognizing how external pressures create specific manipulation incentives that require targeted testing responses. Slide 12, Inherent Risk Assessment, Part 2. Entity-specific risk factors create unique vulnerability profiles. Historical error patterns provide predictive indicators, like criminal records that show specific tendencies towards certain types of crimes. Imagine analyzing Under Armour's prior period adjustments, revealing inventory manipulation. It's like finding a burglar who always enters through bathroom windows. You know exactly where to focus your attention. Account complexity creates technical challenge through measurement difficulty, like trying to count a jar of constantly moving ants. The more judgment involved, the more room for manipulation without clear violation of principles. Picture yourself evaluating accounts where seemingly straightforward processes conceal manipulation opportunities, like trapdoors in a normal-looking floor. Management incentive structures create goal-driven risk through performance targets, like promising a starving person food if they hit certain metrics. When compensation depends on specific financial outcomes, pressure to manipulate increases like temperature in a sealed container over fire. These entity characteristics don't just provide background, they create specific risk indicators requiring targeted procedures. Think of entity-specific factors as the personality profile of your audit client, understanding their specific tendencies, weaknesses, and pressure points. Remember, people, to learn accounting, you must do accounting. And sophisticated risk assessment isn't just identifying general concerns, but pinpointing exact manipulation vectors likely to occur given the specific entity profile. Slide 13, Control Risk Assessment Steps. Control evaluation methodology follows a structured technical process governed by auditing standards. Process understanding requires architectural mapping, like creating detailed blueprints before inspecting a building. Imagine constructing process maps for Zoom's rapidly evolving procurement system. It's like trying to photograph a cheetah while running alongside it. Control design evaluation requires construction assessment against risk objectives, like testing whether a dam is designed to handle specific flood levels. The question isn't just, does a control exist? But is it engineered to address specific risks? Picture yourself evaluating a three-way match process that looks impressive on paper, but has fundamental design flaws, like a beautiful car with no brakes. Operating effectiveness. Testing examines implementation consistency, like testing whether security guards actually check IDs or just wave people through. The most beautifully designed control is worthless if it's not consistently applied, like a sophisticated alarm system that nobody arms. These assessment steps don't just check boxes, they establish the entire reliance framework directing your audit approach. Think of control assessment as a structural engineering inspection. You're not just confirming existence, but evaluating capability to withstand specific pressures. Remember, folks, to learn accounting, you must do accounting. And control evaluation isn't just documentation. It's making sophisticated judgments about whether controls can actually prevent or detect the specific manipulations most likely to occur. Slide 14. Control activities, purchase transactions. Assertion-specific controls create targeted risk mitigation through specialized verification mechanisms. Occurrence completeness controls establish transaction validity, like border security checking both who enters and ensuring no one sneaks across undetected. Imagine examining Target's automated inventory replenishment system. It's like evaluating a self-driving car that decides on its own when to refuel. Authorization/accuracy controls validate transaction legitimacy, like bouncers at an exclusive club, checking both IDs and dress code compliance. Picture testing a client's purchase approval, where override capabilities exist within the system. It's like having emergency exits in a prison, necessary but creating obvious control vulnerabilities. Cutoff classification controls ensure proper period allocation, like making sure runners cross the finish line in the right race, not the one that's most convenient for their time. These controls don't just process transactions, they create specific attestation evidence requiring technical evaluation. Think of assertion-based controls as specialized security measures targeting specific vulnerability points. Not generic protection, but precision defense against known attack vectors. Remember, people, to learn accounting, you must do accounting. And understanding control activities isn't just knowing what exists. It's evaluating whether controls address the specific assertion risks most vulnerable to manipulation. Slide 15, sample controls for purchases. Specific control mechanisms create targeted risk mitigation through specialized verification protocols. Three-way matching establishes transaction validity through multi-source confirmation, like triangulating your position using multiple satellites. Imagine evaluating Costco's matching process, where system integration creates automated verification. It's like having robots check other robots' work with humans, only investigating exceptions. Three-way matching is to purchasing what DNA testing is to criminal investigation. Multiple points of confirmation creating near certainty. But even DNA evidence can be planted, and three-way matches can be manufactured through collusion that creates all three documents in coordination. Sequential documentation provides completeness verification through numerical progression, like checking for missing pages in a book by reviewing page numbers. Picture testing document sequencing in hybrid environments. It's like having both digital and paper ticket stubs that need to reconcile to ensure no one snuck into the theater. Vendor reconciliation establishes independent verification through third-party confirmation, like asking neighbors if they heard the alarm that the homeowner claims was activated. These control mechanisms don't just process transactions. They create specific attestation evidence requiring specialized evaluation techniques. Think of controls as financial antibodies, specialized defense mechanisms designed to attack specific threats to financial reporting health. Remember, folks, to learn accounting, you must do accounting. And evaluating controls isn't just confirming existence. It's assessing whether they can actually prevent or detect the specific manipulations most likely to occur in each unique environment. Slide 16. Control activities. Cash disbursements. 1. Disbursement occurrence and completeness controls create specialized verification mechanisms addressing unique risks of cash outflows. Payment occurrence verification establishes legitimacy, like ensuring only authorized personnel can launch missiles from a submarine. Imagine evaluating JP Morgan Chase's payment controls with sophisticated encryption. It's like having retinal scanners, fingerprint readers, and voice recognition, but still vulnerable if someone has all three credentials. Occurrence controls are to disbursements what authentication is to secure facilities. They ensure only legitimate transactions get executed. Without them, the treasury function becomes as vulnerable as a bank with unlocked doors and no cameras. Unrecorded payment prevention ensures completeness through centralized processing, like having all air traffic route through control towers to ensure no planes fly undetected. Picture testing completeness where multiple payment methods exist. It's like monitoring both official border crossings and potential smuggling routes simultaneously. Bank reconciliation provides critical detective control through independent verification, like comparing passenger manifests against actual headcounts to ensure no stowaways. These control activities don't just process payments. They create specific attestation evidence addressing the unique risks of cash movement. Think of disbursement controls as financial homeland security, protecting the most liquid and vulnerable assets from both intentional attacks and accidental leakage. Remember, people, to learn accounting, you must do accounting. And understanding disbursement controls isn't academic. It's recognizing that cash is to a company what blood is to the body, essential for life and catastrophic when it leaks uncontrolled. Slide 17. Control activities, cash disbursements 2. Authorization and accuracy controls for disbursements create specialized verification mechanisms addressing unique payment risks. Payment approval establishes transaction legitimacy through hierarchical authorization, like nuclear launch protocols requiring multiple officers to turn keys simultaneously. Imagine evaluating a payment system with emergency override capabilities. It's like having a fire alarm that bypasses normal security protocols. Necessary, but inherently risky. Payment approval is to disbursements what prescription authorization is to powerful medications, preventing inappropriate distributions that could cause serious harm. Without proper authorization, the payment system becomes as dangerous as opioids without prescriptions. Payment accuracy verification ensures proper amount disbursement, like pharmacists double-checking medication dosages before distribution. Picture testing Microsoft's payment system that automatically flags unusual patterns. It's like having AI that recognizes when someone's buying materials commonly used for illegal purposes. Vendor master file controls provide critical verification through change management, like background checks before granting security clearances. These control activities don't just process payments. They create specific attestation evidence addressing the unique risks of payment manipulation. Think of authorization controls as financial access credentials, determining who can direct resources and under what circumstances. Remember, folks, to learn accounting, you must do accounting. And understanding payment controls isn't just process mapping. It's recognizing that payment systems are to companies what circulatory systems are to bodies, vital but catastrophic when compromised. Slide 18, Control Activities, Cash Disbursements 3. Cutoff and classification controls for disbursements establish period allocation and account distribution accuracy through specialized verification mechanisms. Period end procedures ensure proper timing recognition, like ensuring runners cross the finish line in the correct race, not the one most advantageous to their time. Imagine year-end at Amazon with sophisticated shipping cutoff analysis. It's like having GPS tracking on every package to determine exact location at midnight, December 31st. Cutoff controls are to financial reporting what photo finishes are to racing. They determine winners and losers based on precise timing. Without them, period allocation becomes as subjective as judging gymnastics without slow-motion replay. Account distribution verification ensures proper classification, like ensuring mail goes to correct addresses rather than whatever location is most convenient for the carrier. Picture testing classification controls where system rules prevent basic errors. It's like spell check that catches obvious mistakes, but can't identify context, inappropriate words. Interface controls between disbursement systems and general ledger applications provide critical verification, like border checkpoints confirming what leaves one country matches what enters another. These control activities don't just process payments, they create specific attestation evidence addressing the unique risks of period manipulation. Think of cutoff controls as financial timestamps, creating permanent records of when economic events occurred regardless of documentation timing. Remember, people, to learn accounting, you must do accounting. And understanding cutoff isn't just calendar awareness. It's recognizing that period allocation is where the most sophisticated earnings management often occurs. Slide 19, Purchase Returns. Return processing creates unique control requirements through reverse transaction flows that inherently carry higher risk profiles. Authorization protocols for returns require enhanced verification, like requiring additional identification for individuals reclaiming checked baggage at airports. Imagine evaluating Zappos' returns processing with their famous liberal policy. It's like having a bank that makes withdrawals easier than deposits. Inherently risky but manageable with proper controls. Return authorization is to purchasing what loan forgiveness is to lending. Reversing a normal transaction flow requires heightened scrutiny. Without specialized controls, returns become the unlocked back door, while everyone guards the front entrance. Documentation requirements for returns create specialized verification challenges, like needing proof of both purchase and defect, rather than just payment evidence. Picture testing returns where credit memos reduce payables. It's like verifying both that money was returned and that the original loan existed. Analytical procedures provide critical evaluation through pattern analysis, like monitoring pharmacy returns for unusual trends that might indicate fraudulent prescriptions. These control activities don't just process returns. They create specific attestation evidence addressing the unique risks of transaction reversal. Think of return controls as financial immune responses, specialized defenses activated when normal transaction flows reverse direction. Remember, folks, to learn accounting, you must do accounting. And understanding returns isn't just process documentation. It's recognizing that control systems, like human bodies, often have weaker defenses against reverse flows than forward ones. Slide 20. Linking control risk to substantive tests. Control reliance methodology establishes the technical relationship between control effectiveness and substantive testing through inverse proportion. Effective controls permit reduced substantive testing, like reliable security systems allowing fewer guard patrols. Imagine designing an audit approach where control testing reveals systematic exceptions. It's like discovering your home security system only monitors front doors when most break-ins occur through windows. The control-substantive relationship is like the relationship between preventive medicine and emergency room visits. Good prevention means less crisis intervention. Without this balance, audit efficiency becomes as elusive as trying to lose weight while eating whatever you want. Ineffective controls necessitate expanded substantive procedures, like increasing police patrols in high-crime areas. Picture yourself at Toshiba, where control override investigation revealed systematic circumvention. It's like finding out prison guards have been helping inmates escape. Standard procedures won't work when the control system itself is compromised. Risk assessment dictates not just generic increases, but specifically targeted expansion, like deploying additional security not randomly, but at specific vulnerability points. This methodology doesn't just allocate testing effort, it creates the entire evidence collection framework directing resources to highest risk areas. Think of the control-substantive relationship as financial defense in depth. Multiple layers of protection coordinated to address specific threats. Remember, people, to learn accounting, you must do accounting. And understanding this relationship isn't just resource allocation. It's recognizing that control evaluation and substantive testing are complementary parts of a single assurance approach. Slide 21. Auditing accounts payable and accrued expenses. Liability testing creates unique verification requirements through specific assertion risks requiring specialized procedures. Existence verification establishes obligation legitimacy, like confirming both that a contract exists and that services were actually delivered. Imagine testing WorldCom's capitalized expenses. It's like determining whether something labeled as an investment is actually just regular spending dressed up for financial statement purposes. Existence testing is to liabilities what paternity testing is to child support claims. Verifying a legitimate obligation exists before resources are committed. Without thorough verification, financial statements become as reliable as campaign promises. Completeness testing presents unique challenges through inherent detection difficulty, like trying to find escaped prisoners who may be hiding anywhere. Picture searching for unrecorded liabilities where management has incentive to understate obligations. It's like hunting for people who don't want to be found and aren't on any official registries. Rights obligations assessment ensures proper entity attribution, like determining which parent is responsible for which aspects of child rearing after a divorce. These procedures don't just verify transactions. They provide specific attestation evidence addressing distinct misstatement risks. Think of liability testing as financial forensics. Scientific examination of evidence to determine the true nature of obligations, regardless of how they're labeled. Remember, folks, to learn accounting, you must do accounting. And understanding liability testing isn't just verification. It's recognizing that liabilities, unlike assets, are often intentionally understated to improve financial metrics. Slide 22. Substantive analytical procedures. Analytical methodologies provide powerful detection capabilities through relationship evaluation. Trend analysis identifies pattern anomalies, like a doctor noticing vital signs don't follow expected patterns given the diagnosis. Imagine applying days payable analysis where DPO suddenly extends from 43 to 67 days. It's like a person who normally pays bills immediately, suddenly taking twice as long. Something fundamental has changed. Trend analysis is to auditing what radar is to air traffic control, detecting deviations from expected patterns that warrant investigation. Without it, auditors become as reactive as firefighters without smoke detectors, only responding once flames are visible. Ratio evaluation provides relationship assessment, like measuring multiple vital signs to create a complete health picture, rather than looking at temperature alone. Picture yourself analyzing Tesla's inventory turnover during Model 3 production. It's like claiming to run a marathon in record time while your heart rate never increased. Mathematically possible, but operationally impossible. Predictive modeling creates expectations through structured formulas, like weather forecasting, that incorporates multiple variables to predict likely conditions. These procedures don't just compare numbers. They provide sophisticated detection capabilities through multi-factor evaluation. Think of analytics as financial MRI scanning, seeing beneath the surface to identify anomalies invisible to traditional examination. Remember, people, to learn accounting, you must do accounting, and sophisticated analytics isn't just calculation. It's developing expectations based on business understanding that allow you to spot inconsistencies invisible to standard testing. Slide 23, Test of Details, Completeness. Unrecorded liability procedures create specialized detection capabilities through targeted search techniques. Vendor statement examination provides independent verification, like asking neighbors what they've observed rather than relying solely on family members' accounts. Imagine testing completeness where vendor statements reveal millions in unrecorded liabilities. It's like finding out someone has secret credit cards their spouse doesn't know about. Vendor confirmation is to liability testing what polygraph tests are to investigations, external validation that doesn't rely on the subject's cooperation. Without it, completeness testing becomes as limited as investigating crimes by only interviewing the suspects. Subsequent payment analysis identifies timing manipulation, like discovering someone backdated checks to make it appear bills were paid in the prior month. Picture yourself at Kraft Heinz, where investigation revealed unrecorded supplier rebates. It's like finding hidden income streams someone forgot to mention during divorce proceedings. Unmatched document analysis identifies processing gaps, like finding purchase orders or receiving reports without corresponding invoices. These procedures don't just confirm transactions, they provide sophisticated detection capabilities for intentionally omitted obligations. Think of completeness testing as financial archaeology, digging beneath the visible surface to find artifacts others have attempted to bury. Remember, folks, to learn accounting, you must do accounting. And liability searching isn't just verification. It's active investigation designed to find what management may have intentionally hidden from your standard procedures. Slide 24. Tests of details, existence and cutoff. Existence and cutoff procedures create specialized verification capabilities through targeted techniques. Vouching analysis provides existence verification, like tracing DNA evidence backward to confirm it actually came from the suspect. Imagine testing existence where supporting documentation appears complete, but subsequent investigation reveals unusual patterns. It's like a perfect alibi that becomes suspicious when too many witnesses tell identical stories. Existence testing is to liabilities what authentication is to valuable artwork, confirming legitimacy beyond mere appearance. Without it, financial statements become as reliable as social media profiles. Period validation ensures proper cutoff through date examination, like determining which fiscal year should include a December 31st evening delivery. Picture testing a client shipping inventory on New Year's Eve. It's like starting a race just before midnight and claiming you finished within record time for the earlier day. Documentation alignment provides critical verification through multi-source confirmation, like comparing witness statements for consistency. These procedures don't just examine records, they provide sophisticated verification capabilities addressing distinct misstatement risks. Think of existence and cutoff testing as financial time travel, determining not just what happened, but precisely when economic events occurred, regardless of documentation timing. Remember, people, to learn accounting, you must do accounting. And cutoff testing isn't just date checking. It's determining the economic substance of transactions to ensure they're recorded in periods that actually reflect when value transferred. Slide 25. Tests of details, valuation and classification. Valuation and classification procedures create specialized verification capabilities through targeted techniques. Discount verification ensures appropriate valuation, like confirming both that a sale price exists and that the customer qualifies for it. Imagine testing a client recording payables net of available discounts despite rarely taking them. It's like budgeting based on coupons you clip, but never redeem. Discount treatment is to liabilities what fine print is to contracts. Technically correct, but potentially misleading if not aligned with actual behavior. Without proper verification, financial statements become as misleading as advertising that highlights up to 70% off, when most items are discounted only 5%. Classification assessment ensures proper categorization, like determining whether an animal is a pet or livestock for regulatory purposes. Picture evaluating a client classifying a loan as long-term despite covenant violations. It's like claiming your house isn't in foreclosure because the bank hasn't physically removed you yet. Accrual methodology evaluation provides critical verification through assumption testing, like checking whether weather forecasts use current data or historical averages. These procedures don't just check amounts, They provide sophisticated verification of measurement precision. Think of valuation and classification testing as financial quality control, ensuring measurements and categorizations accurately reflect economic reality rather than convenient interpretation. Remember, folks, to learn accounting, you must do accounting. And sophisticated testing isn't just recalculation, it's evaluating the reasonableness of judgments and estimates that fundamentally impact financial statement presentation. Slide 26, Accounts, Payable Confirmations. Confirmation methodologies provide independent verification through third-party validation. Blank confirmation designs enhance evidence quality, like asking open-ended questions during investigations rather than suggesting answers. Imagine sending confirmations to critical vendors where responses indicate undisclosed side agreements. It's like discovering unwritten relationship terms that significantly change obligations. Blank confirmations are to auditing what open-ended interrogation is to detective work, more likely to reveal unexpected information. Without them, confirmation becomes as limited as surveys with only yes/no options. Selection strategies optimize effectiveness through risk-based targeting, like screening high-risk passengers more thoroughly at airports. Picture designing confirmation procedures focusing on vendors with unusual patterns. It's like investigating suspects with criminal records before those with clean histories. Response evaluation provides critical assessment through detailed analysis, like forensic examination of witness statements for inconsistencies. These procedures don't just verify balances. They provide independent evidence through unbiased third-party input. Think of confirmation as financial witness testimony, external validation not influenced by management's narrative. Remember, people, to learn accounting, you must do accounting. And confirmation isn't just balance verification. It's obtaining independent evidence from parties with different incentives than management, creating powerful detection capabilities for undisclosed arrangements. Slide 27, Evaluating Audit Findings. Misstatement evaluation creates specialized assessment requirements through cumulative analysis. Aggregation methodology combines identified misstatements, like combining evidence from multiple crime scenes to identify pattern similarities. Imagine evaluating numerous small cutoff errors collectively creating material misstatement. It's like realizing someone took a penny from every transaction in $1 million business. Individually trivial, but collectively significant. Aggregation is to audit findings what pattern recognition is to criminal investigation, seeing the complete picture that individual elements might not reveal. Without it, materiality assessment becomes as flawed as evaluating flooding by measuring individual raindrops. Materiality assessment provides contextual evaluation, like determining whether a temperature change represents normal variation or fever requiring treatment. Picture analyzing classification errors consistently improving working capital. It's like noticing someone always makes mistakes that benefit them financially. Not random error, but deliberate manipulation. Disclosure evaluation ensures complete presentation, like verifying not just that ingredients are safe, but that allergy warnings are included. These procedures don't just calculate totals, they provide comprehensive assessment of financial statement impact. Think of misstatement evaluation as financial jurisprudence, weighing both quantitative evidence and qualitative factors to determine overall impact. Remember, folks, to learn accounting, you must do accounting. And sophisticated evaluation isn't just calculation. It's assessing whether misstatements collectively distort financial reporting enough to mislead users, regardless of individual materiality. Slide 28, Auditing the Tax Provision. Tax provision auditing creates specialized verification requirements through complex technical evaluation. Temporary difference analysis provides technical evaluation, like understanding why identical twins develop different characteristics despite identical DNA. Imagine auditing a client with significant net operating loss carry-forwards. It's like evaluating whether someone's prediction of future lottery winnings justifies current spending. Temporary differences are to tax accounting what time zones are to global travel. The same moment in time appears different depending on which system you're using. Without sophisticated understanding, provision testing becomes as flawed as navigation without accounting for magnetic variation. Permanent difference verification ensures proper classification, like distinguishing between temporary visitors and permanent residents for immigration purposes. Picture evaluating research and development expenditures with preferential tax treatment. It's like determining whether a business trip with some pleasure activities qualifies for full deduction. Provision methodology assessment provides critical verification, like evaluating whether weather predictions use appropriate atmospheric models. These procedures don't just check calculations, they provide comprehensive validation of sophisticated estimations. Think of tax provision auditing as financial quantum physics, understanding parallel realities created by different reporting systems governing the same economic events. Remember, people, to learn accounting, you must do accounting. And provision testing isn't just recalculation, it's evaluating complex technical judgments with significant financial statement impact across multiple reporting frameworks. Slide 29, Common Pitfalls and Best Practices. Implementation methodologies provide optimized approaches through structured techniques. Documentation architecture establishes comprehensive evidence, like creating case files that connect motive, opportunity, and means into cohesive argument. Imagine designing documentation that constructs a complete narrative. It's like writing a mystery novel where all clues logically lead to the conclusion. Documentation is to auditing what medical records are to healthcare, the foundation for both current treatment and future reference. Without proper structure, audit files become as useless as libraries without cataloging systems. Reconciliation strategies enhance detection through systematic comparison, like regularly comparing actual route progress against GPS guidance. Picture implementing continuous monitoring with automated analytics. It's like having health sensors that alert you to problems before symptoms become visible. Control evaluation methodologies optimize reliance through sophisticated assessment, like structural engineering inspections that test both design and actual performance. These approaches don't just execute procedures, they provide comprehensive frameworks enhancing overall audit quality. Think of best practices as financial wisdom, lessons learned through experience that prevent repeating others' mistakes. Remember, folks, to learn accounting, you must do accounting. And implementation excellence isn't just procedure execution. It's applying sophisticated methodologies developed through collective experience across diverse environments. The technical mastery of purchasing cycle auditing requires sophisticated approaches extending beyond standard methodologies. Risk-based targeting optimizes resource allocation, like deploying SWAT teams to high-risk situations while patrol officers handle routine calls. Imagine designing an audit approach concentrating resources on vulnerability points. It's like focusing your home security budget on doors and windows, rather than interior hallways. Strategic resource deployment is to auditing what precision medicine is to healthcare, targeted intervention rather than generic treatment. Without it, audit efficiency becomes as elusive as trying to lose weight with only general advice to eat less. Control integration enhances assurance through sophisticated reliance frameworks, like coordinating air, land, and sea forces in military operations. Picture implementing a dynamic audit program that evolves throughout execution. It's like navigation systems that recalculate routes based on traffic conditions, rather than stubbornly following the original plan. Data-driven analytics transform traditional sampling through comprehensive examination, like genome sequencing, replacing symptom-based diagnosis. These advanced approaches don't just execute procedures, they fundamentally transform the audit paradigm. Think of modern audit methodology as financial immunology, sophisticated protection systems targeting specific threats rather than generic defenses. Remember, people, to learn accounting, you must do accounting. And to master audit excellence, you must continuously refine your approach based on emerging risks and evolving standards. The purchasing cycle may seem routine, but it's where financial statements are won or lost. And now you have the weapons to ensure integrity prevails.